And when you look at the economic expansion, our incredibly long economic expansion that we're in right now, what is the biggest risk factor to that? Is it the Fed?
Yeah, you know, they've always been the one kind of who pushed us over the edge, right? And if they're insistent on hiking rates to the 2.5% or 3% level, which we think is the tipping point, they would probably put us into recession. But I have some confidence that they won't do that, right? And remember, they have this big balance sheet that they're going to be reducing at an increasingly aggressive rate. By this time next year, they'll be rolling off their balance sheet at $600 billion annual run rate. And they keep saying, oh, there's nothing to see here, that's not really tightening. But it is, right? And that can have an impact. The good news is the economy on its own looks really sound, right? The consumer's in great shape. As I said, the banks are in the best financial condition they've been in most of our lives, and certainly my career. Businesses are generally in good shape. Corporate earnings are in good shape. It'll probably be an asset price correction would be my guess to what causes the next downturn.
And when you talk about the balance sheet unwind, it's something we've never seen before. Where can we look to see the impact of that in the markets?
Yeah, that's a great question, right? This is an experiment. I mean, even the ECB, the European Central Bank, is watching from afar saying, well, let's see what the Fed does first, and if they screw this thing up before we start with our own, aggressive tapering and reducing the balance sheet. So it's an experiment. It's the first time in our lives that the Fed has two policy tools that they're using simultaneously, right? So the chance of a policy mistake, just by nature, seems bigger than usual.